GM guys. Welcome to our panel. Today we're going to be speaking about Web2 versus Web3 investments and how the venture capital is changing. And as we know, venture capital has been long an engine power to the innovation, and this new investment paradigm is emerging. And today we're here to talk about this. We're going to talk about the challenges of the traditional exit strategies. We're going to be talking about different fundraising models like token sales, everything in one panel. So stay tuned, stay excited. Today we have some industry leaders with us on this panel that are going to be giving their opinions on the current state of this market. They're going to be talking about different projects. They're going to be talking about what they're looking at when they decide to invest. And the first speaker for today's space is going to be Laura from Gate.io. Hi, Laura.
Hi, Nastasia. Happy to be here.
Happy to have you here today. How's everything going?
I'm in Dubai. Sun is shining. When I have a very busy next week with Token, why can't I complain about anything?
Awesome. Happy to have you here at our space. Tamara, how are you today?
I'm perfect, thank you. Not too far from Laura, so I cannot complain. Also, everything's fine. Markets are looking a little bit more stable, but I don't want to jinx. Yeah, everything is great. Thanks for having me. Excited to be here.
Amazing. So Tamer is an investment director at ChainGPT. Tamer, I'm highly relying on your insights today. We'll be happy to hear what you have to say. We also have here with us Amit from Borderless. Hi there.
Hey Anastasia, how are you? Can you all hear
Really
me
good,
clearly?
thank you.
Awesome,
Yes, we can hear you well.
awesome. Yeah, yeah. So I'm not too far away as well. I think like I think a 2.5 hour flight away, and looking forward, like Laura and Tomer, looking forward to the craziness which starts this weekend for Token. So excited to be here.
Awesome. I guess I'll see everyone at Token then. We also have here Oleg Kurchenko. He's the CEO and founder of Binaryx. Hi, Oleg. How are you?
Hi guys, and thank you so much for joining. I'm doing well. Do you hear me? Do you hear me right now?
Yeah, everything is fine.
Okay. It's a pleasure to have everyone here. Thank you so much for joining again, and thank you so much for the speakers that you have the time to be with us today. I will listen our panel, and of course, like usual, probably I will ask some questions from the side of the project owner, right, from the founder, that will be maybe not really unusual for you, and this is like comprehensive questions related to the projects who are right now working with the VCs, of course. And yeah, thank you so much for joining again. Thank you so much for being with us today. And Anastasia, I give the word back to you.
Thank you so much. Guys, before we start, I just wanted to explain how the space works in case this is the first time that you're joining it. I'm going to address some questions to you. If you are willing to add on to this question, even though it hasn't been addressed to you, please use the panel below. Use some reaction, use an emoji, maybe raise your hand. I'll be happy to pass over the mic to you. If you don't agree with the previous speaker, please let us know. We love to hear different opinions. We know that the truth somewhere is in the middle, and we love a good discussion. So please feel free to disagree if you do so. And let's start with Laura. Laura, the first question that I'd like to begin this conversation with is, what would you say are the biggest differences between investing in Web2 and Web3 startups, given the market volatility, given everything that we know about crypto? Do you think Web3 startups are under pressure to show profitability?
So it's a very good question. I mean, honestly, in this market, sometimes we're laughing whenever we see is maybe Web2 investors know something more than we do. But, to first talk about the differences. So in Web2, VCs are used to playing the long game, like years of burn, product market fit, and then maybe an IPO if a project gets lucky. In the Web3, tokens create a liquidity event in like 6 to 12 months, and often even before the product gets live. So this flips investors' expectations entirely, from equity patience to token urgency. And this rush creates both early upside and brutal downside when the hype doesn't match delivery. So Web2 founders pitch businesses, whereas Web3 founders, they pitch movements. So whereas in Web2, you're backing companies with predictive models like SaaS or marketplaces, in Web3, you're often backing anonymous devs promising decentralization, community governance, and a token that might or might not have a value long term. And Web3 startups don't just need to make money, they need to justify utility. Investors are usually asking, why should your token exist? Can it bring value? And that's very different lens from Web2, where equity dilution board governments are at the main investors' levers. So, one thing is clear, basically, that Web3 startups are being judged in public from day one. Token price becomes the KPI regardless of product maturity. And that visibility brings a level of market pressure that founders simply don't deal with until very much later stage in the journey. So while Web2 is still a slow burn game of fundamentals, Web3 is more about high risk, high volatility, and high expectations from day one. So the investment logic changes across the board, like timelines, liquidity, founder's profile, regulatory urgency are even what traction means. So Web3 is very much either you get a 10x, 20x, or you get nothing. Whereas in Web2, you can exit in the later funding rounds. You can dilute your capital, and yeah, you're not going to get these huge multipliers usually, but the downside is smaller as well.
Thanks a lot, Laura. In your experience, are there any particular verticals in Web3 where profitability is less of a priority, maybe where community matters more, or maybe some infrastructural products?
Honestly, all of them. Like right now, we live in this very interesting world where three investors don't care about that much about the product fit. Not everyone, I'm saying, but a lot of investors. They care about only one thing: will the token do well? Because then you're investing in the token. And the problem is, a lot of projects are creating tokens for the sake of having token without any actual utility. But if investors see a potential there to make money, they will invest. And basically these days it's all about how well can you articulate as a founder of potential multipliers, potential upside the investor can have if they're investing it. Because founders forget that VC investment is not charity. It's not some sort of grant. It's a very high risk loan you're taking, but your collateral is your reputation. So this means if you fail, everyone's going to know in the space and no one's going to invest in your other projects. So sometimes, taking 5-10% loan from the bank seems like a better deal.
Makes a lot of sense. Thank you so much, Laura. Amit, next question over to you. How do exit strategy differ in Web3 compared to Web2? Are there any token unlocks and liquidity events replacing the traditional acquisition or IPO models?
Yeah, sure, Anastasia. So I think building upon what Laura shared earlier, I used to I've been privileged. I think I've been two cycles now in Web3, and before that I was on the Web2 VC side and uh, seen one whole cycle on the Web2 side as well. So for me, the reason I made the move, kind of quote unquote dark side, is because for me, like Web3 VC was Web2 VC on steroids. Everything happens way faster, and the ups and downs, the journeys of the founders, the journeys of the investors is much more faster, and it happens. I think in the blink of an eye. So compared to Web2. So in terms of exit, for Web2, key exits would be like, I think, kind of a lot of people would know, a lot of them through M&A, then a few of them, if they play out well, through the IPO market, through SPACs, listing on company like reverse acquisitions and so on. Those would be mostly, and finally through, if nothing of that works out as a fund reaches at the end of its life, through like a secondary sale to maybe another fund, a secondary fund, and so on. So, but generally the cycles are much longer. So usually Web2 funds would be structured as like 8+2. In fact, some of the key funds I know, they are actually extending their life because they Sequoia actually published a very interesting article where they actually lost a lot of value by exiting when a company got listed, and that gave some several x returns even after they got listed. So but that's on the Web2 side, so easily like 8 to 15 year kind of horizon, good horizon. Whereas in Web3, from an exit point of view, I think the similarity is on the M&A. We have actually seen a number of M&A in our portfolio as well. But from there, I think the most critical one is listing on exchanges, and that's the whole capital market game. And that I think is something which is very different from Web 2. So the cycles in Web 3 could be, you know kind of what we encourage our portfolio founders as well, is to map their listing strategy, capital market strategy with the overall market. So you don't want to do your TG in a bear market. You would rather time it so that you do it sometime in a bull market, where some of the unlocks happen in a bull market, uh, at the same time making sure that you are not a lot of key holders, like we have seen what happened in the recent past with Mantra, right? So making sure that you don't bring up situations like that, where it's a sustained unlock, where it's a sustained sell pressure. I think that is very critical. So as I think what Laura was also saying earlier, I think anywhere from, we have seen as fast as you know like sometimes even 6 months, that those are exceptions, but anywhere from like 1-2 years to 3-4 years, you could expect like a project to go and do the listing. So that I think is a key differentiator in terms of exit. And listing would be equivalent to kind of the IPO in the Web2 nuance. And the third, in terms of secondary sale, that I would say kind of would be in Web3 parlance, would be OTC. So how you do OTC, there are a number of ways to where you could actually sell at a discount if you need some liquidity. Sometimes, or if the fund is coming to end of its life, you could actually structure it where you sell your SAFT, or you sell your kind of IOU as a on a secondary sale with some discount. So that is those are the three kind of exit in like Web2 versus Web3. But what is very interesting is just how fast it is. And the other one kind of more key point here is in Web2, uh, the exits and everything followed is much more, even in private markets there. You have sometimes analysts kind of who follow. You have a lot more governance from investors. Like, we try our best for all our portcos to have as much governance as possible. Despite all of that, you have all these situations which happen with like projects like Mantra, which number of earlier projects, like right now, to some extent what movement is also experiencing. So it's very important for following like some basic hygiene, where founders vesting is more than investors vesting, so that there is no internal sell pressure, where founders make sure that the community knows kind of what wallets they are holding their tokens on, where founders make sure that every kind of and one excellent kind of example how this was handled is the Bybit hack. I think they handled it extremely well. Didn't let the market collapse, didn't let the market confidence go down. So that is something I think which is very critical in Web3. You could have very strong founders, but if they don't know how to keep the community, keep the community informed, keep the community in play, it might actually lead to some very bad results in the token performance. Yeah.
Thank you so much, Amit. You've got one follow-up from Tamer. Tamer, let us know if you can hear us.
Sorry, yeah. Sorry, tried to click the button, did not work. I want to add a little bit something about the difference between Web2 and Web3 to those of you who are not quite familiar about the strategy and the tactics that VCs play and that the entrepreneurs play with each of them. I've been an angel investor myself for the last 14 years in equities, and then moved to crypto exclusively in 2019. And I'm never going back personally to equity ever again. And the reason is that as a strategy, when you invest your money in an equity company, you have no idea if, as my friend said before me, Amit and Laura, you have no idea at the end if they, they're going to be an M&A, if they will even survive, as long for an IPO. And unfortunately, most of the startups are being closed. It's just statistics. You have so many, and there's that much of a traction that you can generate in an overcrowded market. And everything now is almost overcrowded. I don't think there are blue oceans anywhere anymore. That it's a long, risky business, and even if you try to de-risk yourself with a secondary deal somewhere in the middle, it usually doesn't look good. It creates noise, and you are facing a lot of challenges to do so, at least to bring your initial capital back home and to redeploy your funds. Now, in Web3, on the other hand, in token projects, from day one, you know that 99% you're going to have an exit event. You don't know how much you're going to bring back home, but 99% of the times, you know that there's going to be an exit event where something is going to come back home. It can be 10%, 20%, and it can be 100x. But you know that there is a plan for your money to return home and to work again somewhere else. Now about the problems. When Web2 companies, I hate saying Web2 and Web3 because we have many Web3 or equity. So let's just say equity against token raise. Equity companies usually require much more in order to raise money. Equity companies need to have technology, they need to have users, they need to have some kind of attraction in order to attract VCs who will come over and deploy their capital and bury it, as my partners said before me, for a few years ahead in anticipation that they will be returning their capital a few times fold. But that relies on technology, traction, on real KPIs that have been proven on the ground, as we say. In Web3, unfortunately, most do not need it. And fortunately for us, it's changing now. This whole thing is changing. So in Web3, basically, you can have a pitch deck with a few nice faces to throw a few logos there and a few fancy names and promises, and to raise by whatever valuation that you want. You can say 8 million, 20 million, 50 million, 60 million, 100 million. It's basically whatever the people will throw at you, whatever the biggest fish will believe that you're worth, and this will be your market valuation. Now, in equity world, ladies and gentlemen, to reach to a valuation that companies in Web3 are raising pre-IDO, it's completely ridiculous. Like it doesn't exist. Usually companies, trying to raise with a valuation of $1, $2, $5, $4 million, in equity as a seeder, where we're seeing completely different numbers in token companies. Again, it's because we know that the token companies are going to be already listed, and they're going to be a liquidation event for the investor. Now, question is how strong you think the team is, and if they will be able to do it with the technology or traction that they have at the moment. Problem with the model is that it attracts some bad actors. It attracts a lot of bad actors, or basically printing projects and printing pitch decks every quarter or every second year, and doing a tour and raising funds over and over again to their projects without you even knowing if there is going to be something that will be launched, because investors and VCs are usually being replaced in this industry quite a lot. To those of you who've been around, remember that in the previous bull run, we saw different centric players in the industry that were VCs and angels, but we do not see now, most of us. Usually because either they've been eliminated or that they're just fat enough and they decided that they're done with the game and they're moving on. In equity, you do not see it. You see VCs who have been here for 20 years, 30 years, and basically created the foundations for this industry, where names that bring with them a lot more value than a VC that just showed like 6 months ago and did two nice pumped tokens that no one cares if even they have technology or an infrastructure built behind them. So just wanted to clarify it for the audience who might not know the exact difference between both investment types. Oh, and the most important thing, usually guys, in token projects, unfortunately, and it's also changing now, the project do not require to tell the investors what they've done with their money. Basically, they can raise $20 million and no one knows where the money went to. While in equity, usually the investors, of course, due to the nature of equity, they hold piece of the company, they can actually demand to see the expenses and to know exactly what went on with the money. In token companies, guys, it doesn't exist. Like they can just raise $10 million, say, sorry guys, we spent all of the money on trying to build our product and market it, and unfortunately it failed. Well, as far as you know, the addresses that they sent money to were for their parents and their cousins. Another big issue that we're having still in the industry, it's all about trust. Good thing and a bad thing, but something to think about. And I hope it was eye-opening to those of you who do not know the difference between the two tactics.
Thanks a lot, Tamara. You're being brutally honest today, as always, in our spaces. I guess somebody had to say it, but your spicy comment, had a reaction from Laura. Laura, please, mic over to you.
No reaction. I was listening to Tomer, and I remember this one funny story from the peak of the last bull cycle. So basically, there was a project I was raising, and the founders were like ex tier one project. Think like, I'm not gonna say who, but think like ex Solana, ex like Avalanche, like very very successful projects. And they were basically raising with just a blurb. There was no website, there was no pitch deck, nothing, just a blurb. And this blurb was shared around Twitter. And I remember I got it. And as I started to ask some questions, and after like a second question, the message I got was like, so either you're investing or don't waste my time. Literally like this. And the funny thing is, the project actually raised, and they raised more than 10 mil from like some really serious VCs. And it was the peak of the bull run. Do you think the project ever succeeded? Of course not. So just listening to Tomer, like I just wanted to add, like this space is so sometimes funny when you realize everyone has way too much money that they don't know where to put it. And then they start doing projects for the sake of doing projects, and investors trying to deploy capital for the sake of that they need to deploy. Whereas the difference, for example, with us, with Gate Ventures, we invest in only a few projects. We don't invest a lot, but we're very particular in what we're investing in, because in the end, we're investing our own prop capital, and we don't have the luxury to fail it, because it's not like coming back to LPs and be like, oh, oopsie daisy, sorry, we invested wrongly, it's venture capitalists to rescue. It's our own prop capital that we're deploying. But yeah, this space is hilarious, and Tomer has like a lot of great things that he was saying.
Yeah, that pushed me on the. I'm really sorry to take the mic. That pushed me on the mind that industry right now become more mature, because if to compare it with the Web2 industry, right, with equity industry, as Tomer mentioned. So if to compare it with Web2 industry, we understand that Web2 bubble and the .NET bubble also was like that. Like, so people create the websites with .com, and just with that they are raising money. And right now we have several cycles on the crypto space, and the crypto space become more mature. Investors become more skeptical. Investors become more careful, and everything is going to the point where, like, all that cycles was already passed through with the Web2 industry. And how do you think, guys, do we come to that point of compliance and due diligence stuff as Web2 industry has? Or how much cycles we need to struggle from that kind of projects that would like to make a fraud for for investors? That what you mentioned. Any thoughts and opinions?
So many challenges there. Oh, sorry, Laura, I didn't see that you were politely raising your hand. Please, if you'd like to take this one, then
No,
go.
I wasn't. I think Twitter just glitching.
Ah, then then I will take this one. Regarding
But thank you
the how
for
do we
being a gentleman.
of course, of course. One of the most problematic things here is lack of regulation. We all like, to think, that we are taking control back into our hands, and that we're decentralizing everything and power to the people, and we're not giving anything to the rich who run this world, and we all want to have fun, and trust each other, and let's have fun. But unfortunately, we see that more and more bad actors are joining this ecosystem. Like, for example, like guys, take Pump.fun. You can print whatever token you want, like a casino, and people are just throwing money there. It's stuff, hoping that something will come back from the table that they threw money at. And if not, after a while, they just cut their losses and moving on to the next table. Now, and you're asking yourself, how is this regulated? At the end of the day, holders are holding tokens. Something generated this thing, and do they need to provide any answer to anyone of what they're doing with the money, or did we as the Web3 community completely accepted the fact that we are gambling on just random names and smart contracts that are being generated by a machine, by someone completely anonymous on the other side, even if we have complete no knowledge about what they're building, what they're doing, and what their funding is going to. On the other hand, through that Pump.fun project, machine, 3 projects of mine, like teams, that I've been working with for a very long time, have basically launched because they wanted a pure community launch, fair launch. They launched 3 tokens in the realms of AI agent technologies and infrastructure, and they are using the money and even their out-of-pocket money to actually fund their operations, fund the liquidity pools, push everything, market it, and they brought technologies that they've been developing for 3 years. Now they're launching in the same platform. Should we regulate both players and both entities in the same way? The real builders and the ones who are just scamming, and trying their luck, to extract liquidity from the market. It's very hard to say. I think that what this industry is going through is a very interesting process of trying to understand what kind of a beast we've created over here, and how to handle and harness its power. We all want our privacy, for example, but and some of us even want our anonymity. But is being anonymous is the right thing to do, or is your privacy is the right thing to keep? This is a big question that I'm not sure that anyone can answer yet. Like, I don't mind you guys and me, for example, being, private with our information and being, keeping our stuff private for ourselves, and no one will know who we are from each other. But should we be anonymous? For example, if I'm doing something and I'm scamming and I'm stealing, is it fine that I'm anonymous? And no government, no DAO, no one knows who I am and can come with demands to me. So we have a lot of problems here. We can all hate the police, right? And say, the police are bad. We hate the police. They only make trouble. But when there's a thief outside of your home, it's trying to break in, and you're calling the police, you're praying that the police will come running to save you. So regarding regulation, I think that the nature of decentralized ecosystems and the immutable nature of token creates a lot of challenges for us to regulate it all at the same time, especially due to the fact that we're all coming from different places, different laws, and different structures that allow or do not allow us to do some of the things that we are doing. I think that the future of these investments should be at core with some kind of licensing from some kind of an entity to launch your token. I don't mind you launching it, and doing it all around the world and raising funds from everyone around the world, which is nice and amazing through this beautiful power of blockchain. But it's fine that you will be private and they will not know who you are. But being anonymous and no one knows who you are and where you're going with the money that you took from people, this is a real challenge, if you ask me. This is a problem that we're having, and we do need to solve it as an industry.
Thanks a lot, Tamer. You named today a lot of red flags but I'd really like to hear a little bit more about your personal checklist, the green flag list that you're following through when you decide whether to invest in a certain Web3 project. But before we do that, I'd just like to give a word to Ayman, who just joined the space. Ayman, if you could do a small intro about yourself, and I guess you had a follow-up to one of our speakers, please do so.
Thank you, guys. I hope you hear well. First of all, thank you for the great space. I couldn't resist seeing Tumer and Laura in one space. Two good friends had to join. My name is Ayman Sayed. I'm the CEO founder of Thrivo. Been in the industry for 10 years and had the chance to work with both Laura and Tumer for a while. Tumer being our good friend, advisor, brother, and investor, and Laura we've known each other for the past two bull runs. I wanted to add something on what the guys are saying, because we are one of these companies who are just basically blurring the lines between Web 2 and Web 3. We have both Web2 and we both raised for tokens and equity successfully over the past year. I have to add something that it all comes.
I think we've lost Ayman, or is it just on my end?
Yeah, we're checking
Right?
checking in the back in terms of what happened to Ayman, but he was thrown out of the space. Thanks
I
God
was
we're rockets here.
yesterday, and it was so bad. Like Twitter is not working at all these past couple of weeks.
Horrible. I always have a laugh about it, that you look at Elon Musk, right? The guy basically sent, the first, commercial spaceship, and they made, electric cars, the thing, in the world, PayPal, everything that you thought was impossible, he did. And then you look at Twitter and you say, even Elon Musk couldn't fix Twitter. It still sucks. It's like, it's amazing. No one can fix this thing. We have video calls and Google Meets, but they cannot fix the simple Twitter
He
spaces.
fired like 50% or more staff when he purchased Twitter. I think he fired a lot of people, and that's why it's not working.
Totally, but apparently he did not replace the one guy or girl that were supposed to make sure that this thing will work as Twitter Spaces. But
Okay, guys, good news.
jokes aside,
Oh, sorry, apologies. Good news, Ayman is back. Ayman, could you hear
Sorry,
us?
guys. Can you hear me now?
Yes, we
Twitter,
can
I'll
hear
tell
you.
you guys, I have my own things about Twitter as well. And like we're building, it's not directly a competitor, but I can understand how hard it is to have everything working smoothly. I wanted to just add few things. I mean, we've been one of these companies that have been building, basically blurring the lines between Web 2 and Web 3, right? Bringing what the Web 3 experience on an experience that people love and understand with Web 2. So from our experience, we raised both with equity and tokens. And what we found out, it all comes down to both the users and the technology, both in Web 2 and in Web 3. If you have the users, if you have the technology, if you have the team that is capable of scaling the technology and the users to reach new markets, to reach the millions, right, while solving problems, then it's a no-brainer for VCs to invest, right? In Web3, it's coming to the same kind of conclusion. Why? Because people have been burned over the past years with having tokens that have no utility, right? No user base, just hype, right? A group of KOLs came in, wanted to hype a project, boom, liquidity grab, salam alaikum, done deal, right? So it made it really hard for a lot of really good projects for really good projects so that they can go and raise. From our experience, it all comes down to users in Web3 as well. Today, why? Because people are trying to and de-risk their investments. It's right. It's a much easier way to do an exit using, for example, a TGE event, right? If they have all of the fundamentals, right? They have the user base. It means there's demand on the token. It means there's traders, right? And it's basically a token that is sustainable. So what we did, we made sure that, okay, we ask ourselves a question. If we're building this technology, do we need a token in the first place, right? Because if we can demonstrate that we have the user base and the technology, we don't even need to go through raising for a token. Now, the interesting part that we found out, right, what crypto allows us to do, right, is to create this alternative medium of exchange that is called the token. So if your users, right, if you have the users that are really using your token for a certain utility that, you know, that satisfies their need, their interest, right? And around that, there are thousands or hundreds of thousands of other people that are doing the same thing, then the token is sustainable. For us, the equity investors were more interested in the long-term vision and in the long-term technology that we are building, compared to the token investors that were more interested, okay, you guys have the experience as a team, you build, you demonstrate, you have a track record of actually doing the X's. Then what happens next is what this is a project that we have to invest in. So just wanted to add these 2 cents. To Mehra is the same with Laura. So I really appreciate having you guys around us and looking forward to see you in Token 2049. Thank you guys for the opportunity to speak.
Thanks a lot, Ayman. Laura?
So I will start again with the joke that we have in the fund. So you know what's the ideal company that any VC is hunting for? Is ex-OGs who bought Bitcoin in like 2012 and they were founders of like Solana, who are building a novel technology that's never done before. They already have Sequoia and H16Z and like Pantera Capital at their cap table, and their valuation is like 10 mil or below. It's a unicorn. But that's basically the ideal thing every VC is looking for, which is realistically not possible to find. And the thing is, everyone, when they approach VCs, they kind of have this idea that the VCs are just sitting here comfortably, you know, on their thrones and being like, okay, I maybe give you money, maybe I'm not gonna give you money. Like, we have so much choice. But realistically, there is not a lot of really good projects in the space, and investors need to fight with other investors to get allocations. Because realistically, if you are this superstar unicorn founder with all of these things that I just mentioned before, you are the one sitting on the throne and deciding who you're gonna give the opportunity to invest in your project. And like, you know, the power dynamic shifts very, very quickly. So when we're looking into projects, in the end, we're looking for founders with experience, someone who already have the track record and very clear understanding on how they're going to make the multipliers. And yes, you might probably ask me, hey, but what about early stage project? You're a first time founder, you don't have the track record. Then probably you're too early to go to VCs, and maybe you just need to have a very good angel network, advisors, and maybe go to incubator. There are a lot of amazing incubators and accelerators who will help you out when you have nothing. Yes, there's always a price to pay, probably in terms of either equity or large amount of tokens. But if you have no one, you need someone to give it to you. Whereas you should be only going to VCs, especially if you want to get tier one VCs, where you already have something to show, where you either have your past experience to back you up or traction. And what does traction mean? Traction means very clear example or things gonna show that once you're gonna do a token launch, your token actually is gonna pump. Because in the end, again, as I mentioned before, it is not a charity. Investors want to make money. And then also, if we're talking about from the exchange perspective, because you also need to do a TG. If you go to exchanges having no community, expecting the exchange to give you all this purchasing power, well, you're gonna get disappointed because exchanges are not gonna give you purchasing power. They're gonna give you some part of it. Realistically, you need to build that community who is gonna be excited on the day of the launch, and because in the end, you're gonna be fighting your sell pressure, whatever amount of unlock you have on DG, and you need to have a lot of buy pressure on that day. And then after you launch, you need to think about the long-term strategy, because with all the unlocks, if you had airdrop, if you had a lot of early investors that are gonna get some unlocks after a certain amount of time, they are gonna dump. They 100% will dump. So the question is, how are you planning to sustain the price and even counter that sell pressure that you're gonna have throughout a year or 2 years after token launch? And this is where a lot of founders fail, because they think, oh, we did TG, that's it. Now it's relax time. It's not. And that's why I personally believe, and again, I'm in the space since I was 16. I had a marketing agency before. 80% of projects don't need a token. They can be a great crypto technology, might need blockchain to do whatever they're doing, but they can just have a good sustainable business where they generate profit, so on, rather than betting on the token. And if projects come to us and we ask what's the utility, and they say utility is the governance rights, voting rights, or reduce fees in transactions, I'm like, just get out. Like it's not gonna work. Like it's not a utility. So with that, I'll give the microphone to Tomer. I see you want to add something.
So thank you for the privilege to add to your words. So I couldn't agree more with what Laura said. Like seriously, guys, like with everything, with all of the analysis, token has no usage. Just don't touch it, don't use it. The governance story, it's nice, you know, but it's nice when you are like already a huge titan, and I mean like Aave, Jupiter, Arbitrum. You know, then you know I will take the governance story, but just you know for a protocol that has basically 100 real users and another 100,000 fake bots that were participating in the testnet airdrop campaign, and telling me that they're going to be a voting power with a decentralized governance for whatever, definitely that's a no. Don't touch this thing. When I'm analyzing teams, you know, and I'm biased, for example, because Ayman, you know, is also a portfolio company of mine, and a dear friend and one of the most interesting and best fighters in the industry that I know. Full transparency, also a Binaryx. So I will tell you what I'm looking for when I'm investing in projects. My time and money will go to a project that has one of the following. It needs to have either a team with real proven experience, meaning they already earned their stripes. They had a different project or a company that I know post exits. They succeeded, and even if they did not have an exit, it was a huge product that everyone know and everybody use, and now they're creating something commercial. Then this is one. Two, they need to have some kind of a technological edge. By the way, it's not all of them. It needs to be, although at least two of them of the following things. So they need a technological edge, meaning that I need to jump on a call and they need to show, you know, something that I will look at the technology and I will say, oh my God, this is like Nokia seeing iPhone for the first time. You know, those of you who are old enough like me, remember that day. They just stood there and like Nokia said, that they saw technology that is 7 years ahead of what they will have today, that it will take them 7 years to get to it. Then technology. Three, amazing backers. And amazing backers would be, you know, as Laura said, you know, the big names that I know that to pass their DD, you basically need to kill yourself 6 times and show that you're still alive and pass all of their fire trial tests. You know, I'm now looking at Dex and I see some of the biggest names out there, you know, and I don't want to mention names because I don't want anyone to be insulted by me, you know, not to mention them. But the biggest names there, then it's good enough for me. Or four, they need to have already like serious traction that I cannot I cannot say anything about. For example, hamster combat. Remember that thing? So, you know, no one knew basically what they're doing. It's not being used by anyone. It has no purpose. Or Notcoin, you know, and the rest of these great projects, you know, became huge. They have that huge of a amount of users, you know, that are just voting with their fingers and phones for them, using them daily, that I cannot argue with their success. So if they have two out of these four, I'm in. If it's a three, or a 4 out of 4, it's a shut up and take my money. Please give me an allocation. I beg you. So that's how we're working.
Thanks a lot, Tomer. Laura, Amit, do you guys have anything to add to this amazing 4 bullet point list?
I agree with absolutely everything that Tomer said. And just want to add one more thing that we kind of care a lot about is novel technology. So he kind of touched on it, but like founders who are listening it, if you see a successful project on one layer and one, don't fork it to the other. I see so many forks right now of like Athena, of Hyperliquid, on some other project. Like if something booms on one chain, they're forking it to the other. Don't do that. it's not gonna work. But overall, I 100% agree with Tomer. Just either you already have a track record or just go and work for a large company. Maybe spend a couple of years working for some tier one company, building relation, building credibility. If you're especially a young college student, let's be realistic, you need to get that experience. Like I'm in the space since 2016, almost 10 years. And I see a lot of these young people see these stories, especially like with Pump and Fun, where these young kids from Europe became millionaires overnight. If you know their story, it's a ninth project. They have tried 8 different projects and they failed, and Pump and Fun was the ninth one. So that's a track record. Trying 8 times, failing, and doing it again. So have experience. No one's going to be giving money away as it was in 2016, 17, 18. The industry is much more mature and you need to show your track record.
It reminds me of a story. Laura, again, I think we say eye to eye. We need to share more deal flow. We'll talk about it later. But so it's been told. I've been told, years ago. I had 5 startups, 3 destroyed me financially, and then two I had 2 successful exits. And then I became an angel investor. It's a story for of old people. You don't have time for this now, but I've been told, the story about this guy, and that was the quote. It was a quote by this guy that says, "My first project was a horrible experience. It was a completely miserable failure. The second one was even worse than the first one. I've destroyed all of my capital. The third one, I got some money from friends and family. I thought I know what I was doing, and then I destroyed everyone's capital. The fourth, the fifth, and the sixth were not better than my other experiences. I kept on destroying capital and funds of others and myself while trying to achieve something. The seventh worked, and the quote was by Elon Musk, founder of PayPal. So it's exactly, like Laura said, about Pump That Fun, that people do not know, how much the founders had to go, in order to reach to the product that they have now and to the success that they're seeing today. People think it happened out of thin air, and then like mushrooms after the rain, suddenly you have so many people are forking the same stuff you have on GitHub, and your smart contracts, and are trying to replicate your success, and are basically will all end like a quick cash grabs at best. Then yeah, totally, guys. If you invest in someone, do your research. If they're putting McDonald's, at their logo as their past experience, it can be that they, were the chief finance officer at McDonald's, and it can also be that they've been a McDonald's delivery guy. But people do keep on putting, these logos without even people asking themselves, what did they do in that company? Happened to me more than once to see people, putting logos of Microsoft and Google and Deloitte and, these huge brands. And then, I knew that there were interns there for 5 months or 4 months, or they worked as a secretary for a manager there or whatever. And then basically put their logos there. Yeah, DIYOR always, guys, and it takes a lot to succeed. Before giving the right to Amit, please to continue, there's a joke, that I must say. I was told once, when you're pregnant, but by a friend, a lady friend from the industry, she said, when you're pregnant, everyone congratulates you, but no one knows how many times you needed to get fucked in order for this thing to happen. So excuse me for being so brutal, but it is true, guys. It's definitely not easy to get to the point when it succeeds. Please, Amit.
Yeah, difficult to follow that joke, Tomer, but I think you guys covered it well, Laura, Tomer. I think the only thing maybe to add is and a little bit, I think, believer in how us as investors, can uh, like one thing is easy to point fingers at others, but I think also important like how us as investors can do things better. So one of the things, kind of self discipline, so one of the things we try to do is more often than not, almost kind of every week we do come across something which sounds very appealing. It has some big names, some good logos, and it looks like, hey, the round is going to close soon. And there is always this feeling of FOMO, which is so kind of so prevalent in Web3, where you don't you think you got this thing at the right time just before they were able to close, and you feel that, hey, maybe I should put something in. Otherwise, I will not, my logo will not be there, or I will not be there on the cap table. But I think that is something which we have been trying to have more self discipline in, trying to make sure not to fall into FOMO, trying to make sure that, in fact, some of our best returns have come where we have actually, so we try to lead, come in as early as possible, try to lead. And some of our best returns have come where we had a conviction in the entrepreneur, and we came in early and took a sizable portion of the round, and actually saw the entire journey. So I think that is something, just one more point to add on all the comments which Laura made.
Thanks a lot, Amit. Guys, we're going to be wrapping up with this space for today. Thank you so much for the incredible comments that you've had. Thank you so much for the discussion. Really good energy, and it wasn't just empty words. Sometimes this can happen during the space. A lot of really good knowledge. To our audience, thank you so much for coming. Whether you're a founder, investor, or just Web3 curious, we hope you are walking away with a clearer view of how venture capital is working. And thank you so much again to Laura, to Tamer, to Amit, as well as Ayman and Oleg for sharing your expertise. Let's keep this conversation going in comments. Feel free to connect with our speakers after the session, and enjoy the rest of your day. Stay curious. Thank you so much.
Thank you so much, everyone, for joining. Wish you a really, really great day, and see you in Token 2049, guys.
Thank you, guys. Stay awesome and have fun at Token. Bye.
Looking forward to see you here in Dubai.
Thanks, guys.
Thank you for having me.